although battery storage would not help with the inertia problem right away, it would help stabilize the delivery or the frequency of the output from solar. And the government has already set up a very ambitious target to basically increase battery storage capacity by 10 times through 2030.
If you really want to nerd out on this topic, if you take solar and a combined cycle gas plant and do separate LCOEs and then do a combined where you basically put them together, the combined is actually lower than if you just do gas on its own. So I think in a lot of markets, that probably doesn't work with cheap Henry Hub pricing. But in a lot of markets, adding solar is reasonable, brings down your total system cost, but you have to have that pairing.
We don't think that is going to deteriorate the long-term outlook for renewables, because you look at the power mix in Europe, especially, renewables are still the answer for additional demand. They're the cheapest technology, and I think there's an argument to make about keeping nuclear open for longer, etc. But renewables are still the answer for new demand.
Iberia is sort of an outlier in Europe in the sense that grid investment in Spain is very much capped or limited to only 0.13% of GDP. So that is very much an outlier in the context of European grids, where you've seen in other countries like Germany and the UK, network portfolios are growing by high single digits, while Iberian network portfolios have been pretty much flat over the past 5 years.
So it has been a pretty bad month for oil prices, and what we've been watching, and I think the two key drivers behind this has been, of course, the macro, which has become a lot more important of a driver for oil prices, and OPEC. So on the demand side, macro, I mean, we're seeing already that the trade wars are hitting GDP growth and hence oil demand.
Thinking about the idea of a kind of $50 a barrel case and what it could mean. And I think broadly for the Canadian E&Ps, it's pretty similar to where a lot of the U.S. and European majors are at. $50 is not good, but possibly you are able to sustain maintenance capex and dividend at that level, but buybacks are likely to be the casualty. Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we have Salih Yilmaz joining from his usual perch in Dubai, swinging over to Madrid. We've got Patricio Alvarez joining. Then up to London, we also have Joao Martins on the call today. And we're going to dedicate a little bit of time to unpacking an interesting and recent development in utility land. Just the other day, Spain had a major blackout where Patricio is located. So I think you're well positioned to perhaps tell us a little bit about how to interpret what happened. And I think many folks seem eager to rush and blame renewables for the blackouts, but give us your assessment. How do you interpret what happened, and are there any takeaways based on what we know at this point?
Sure. So, well, first of all, it was an unprecedented blackout in Spain. So we've never had one that has been as widespread or as long as it was. So this was on Monday around 12:30, so around midday, and it lasted for roughly 10 hours, just to recover the tension or the frequency of most of the national grid. So to answer your first question, I mean, there is still no detailed explanation or I would say satisfactory explanation as to what happened. If you looked at Red Eléctrica's, the national grid operator's website at noon, you would just see that generation volume fell roughly 50% in the matter of 5 seconds. Everything is pointing to some sort of failure in the grid. But at the time that that grid failure occurred, which is still undetermined what the specific cause is, at the time that that happened, there was a relatively high share, a very high share of wind and solar in the grid, and a very low share of combined gas cycle output, which experts are saying that possibly the change in frequency in the grid was caused by a lack of inertia that comes from cycling or spinning sources. So that's dispatchable sources such as gas and coal. I'm not sure if actually nuclear qualifies, but that we had a significant share of nuclear. With roughly 15% of the grid was supplied by nuclear. So, starting to dissect the reasons becomes really hard. But it depends how you want to interpret it. There was a really high share of solar in the grid at the moment that the failure occurred, but it's undetermined if it's really the grid that is not prepared to cope with a high share of renewables rather than the renewables themselves causing the failure.
And what do you think the likely response is going to be from regulators? Are we going to see more investment in the grid as a result of this? Are we going to invest more in batteries, more in spinning reserves? You've got a note out, so I'm asking leading questions, but tell us what you think comes about next.
Sure. So I think, it's easy to jump to conclusions that that the main conclusion is probably that Spain needs to invest more in battery storage. Although battery storage would not help with the inertia problem right away, it would help stabilize the delivery or the frequency of the output from solar. And the government has already set up a very ambitious target to basically increase battery storage capacity by 10 times through 2030. So that's we have roughly almost 1 gigawatt already, and they want to build out 11 more. So let's say the government is aware of this, but I think the acceleration or the pace at what we are seeing utilities build them is not up to speed, let's say, to what the planned outcome is. We also expect slower deployment of solar capacity. It is something that we've also seen in utilities investment plans over the past few years. They have pared back on solar capacity investment, and that's not only because of renewable penetration, but also the consequences of it. We've had more instances of negative power prices in the grid over the past few years. They have increased, so that just makes the case, let's say, for building new solar capacity in Spain, a bit harder, at least in the midterm, we believe. And the other vector or the other solution is to invest more in the grid. It is something that, again, it's very, let's say, opportunistically or well-timed, I guess, that this occurred is because a lot of the utilities in Iberia are seeking higher returns on their networks. And Iberia is sort of an outlier in Europe in the sense that grid investment in Spain is very much capped or limited to only 0.13% of GDP. So that is very much an outlier in the context of European grids, where you've seen in other countries like Germany and the UK, network portfolios are growing by high single digits, while Iberian network portfolios have been pretty much flat over the past 5 years. So if anything, if there is, let's say, a strong response from the regulator, it would be perhaps to provide incentives to boost network resilience and to increase the size of those network portfolios.
Thank you. Joao, let's bring you into the conversation. I'm curious to get your read on this because renewables do seem to be a big part of the growth story for a lot of the European utilities. Although I do get the sense from you that there has been some pullback in CapEx expectations in recent times. But, are you worried about events like this being something else that could further test whether, the regulatory bodies want as much renewables?
Thanks for the question, Rob. I think in the short term, no, we're not worried about that. I think in Europe, especially regulatory bodies and governments are still very much committed to their targets. episodes like this might support, like Patricio hinted at, they do support a higher focus on grid spending. And like he said, in the rest of Europe, um, grid investment is already being ramped up quite a lot. You look at Germany, the UK, other parts of Europe are really trying to shift the focus. Maybe until 2 or 3 years ago, the focus was very much on renewables growth, adding as many projects as possible. And that has shifted towards improving the reliability of the grid, towards connecting the backlog of projects. And so in that sense, there is already, like you mentioned, a slowdown of renewable investments that also reflects tighter funding conditions. And as that slows down, utilities are shifting investment towards the grids. And we're seeing that regulated peers are being the ones that will likely benefit the most from that. If you look at an European level, and taking, for example, the estimates from our colleagues over at PN, Bloomberg and EF, grid spending needs to increase by 40 to 80% on average over the next 5 years versus the past 5 years. So that's just until 2030. And it will continue to increase by then. And so what we're seeing from utilities is simply a shifting of a temporary shifting of investment. But we don't think that is going to deteriorate the long-term outlook for renewables, because you look at the power mix in Europe, especially, renewables are still the answer for additional demand. They're the cheapest technology, and I think there's an argument to make about keeping nuclear open for longer, etc. But renewables are still the answer for new demand.
I'm curious to hear from both of you. We'll come to you first, Joao. But is there pushback on the potential cost of all of this grid spending? I mean, I think in the background, people want the lights to always work, and ideally they want as low cost of electricity as possible. And so I want to get your sense of, there's this perennial debate. When you do an LCOE analysis, you sort of, I think, rationally arrive at this idea that renewables are pretty cheap forms of electrons. But then there seems to be a mismatch on kind of how that fits into the overall grid calculus. And so I'm just curious to get a sense of, are regulators really going to be able to push on the cost of this additional grid spending? Do you think it's a lock? Will it definitely happen? The consumers pushing back? So, Jav, over to you first.
Yes. Well, that's a great question. I think it's probably going to depend on the country, and I think there's also a consideration to have of how much support governments have until now given renewables and how much they can give going forward, as public finances are also constrained, which means that if governments cannot give the level of support that they've given so far to renewable projects, then it would fall onto increasing PPAs, increasing power prices, increasing grid tariffs, ultimately to consumers. And as you said, then that will contrast with what most governments are now shifting towards, which is focusing on lowering power prices and energy prices in Europe. That's the case in Germany, for example, which is an interesting case where the government is coming in. There's a real need to increase grid investments. There's to connect all the offshore potential offshore build out in the north. And at the same time, that contrasts with the need to lower tariffs to end customers. And so that will play a role into how these regulators and the governments are trying to decide. I think for the grid side, for the grid investment side of things, you still need to improve the reliability. You still need to connect all these new projects. And so the answer is that ultimately, if regulators want utilities to invest, then they need to find a way to provide higher returns. And I'll leave it to Pat.
Yeah, so and maybe Patricio, just give us a sense. I generally get the sense that most regulators offer pretty healthy ROEs to grid type investments, but are we seeing that come through in some of the numbers there?
Sure. So I guess one good place to start is that yeah, the let's say power prices or spot wholesale power prices in Spain are among the lowest in Europe. But how that how that lands in a household's bill, it's quite different once you look at the bill. Really, wholesale power prices really represent less than half of what the overall bill, the household bill is, and most of that is taxes, is green taxes. It's a levy on nuclear power to fund the decommissioning of Spain's nuclear power plants. So these are all, let's say, the add-ons and the grid fees and all that. So if anything, increasing grid investment would probably result in a higher household bill, although you could probably reshuffle some of the levies, although that's not our remit. But yes, increasing grid spending in Spain would probably result in higher bills. But like Joao said, I think it's pretty clear now that perhaps we need to slow down renewable deployments and perhaps focus on boosting the resilience of the grid. And if you compare it to, let's say, retail prices in other countries in Europe, Spain's are still amongst the most competitive. So in that context, it wouldn't be so bad. In terms of the regulation itself, we are right now we're about to finish the regulatory cycle that started in 2020 with a fixed rate for allowed returns on assets, which hovers around, which is not around, it's 5.58%. With the main difference versus other countries is that in Spain that regulatory remuneration is fixed, so that means that it's not indexed to inflation. It does not allow for cost recovery. Like other rates, for example, in the UK and Germany, which allow you to do that cost pass-through. So if anything, grids or grid operators in Spain have to be, let's say, extra efficient in curbing or reducing costs faster than inflation in order to produce any profit growth. So it's not surprising that grids in Spain have seen flat EBITDA and flat regulatory asset-based growth over the past 5 years. So to your point, it is perhaps well-timed because let's say the regulatory framework for the next period starting in 2026 is being discussed at the moment. So I guess it's a matter of policymakers having the intention and the willingness to make that shift to perhaps lift the cap on spending, which would allow companies like Iberdrola and Endesa to spend more money on their Spanish grids.
Very interesting. Here's an interesting thought exercise for folks listening. If you really want to nerd out on this topic, if you take solar and a combined cycle gas plant and do separate LCOEs and then do a combined where you basically put them together, the combined is actually lower than if you just do gas on its own. So I think in a lot of markets, that probably doesn't work with cheap Henry Hub pricing, but in a lot of markets, adding solar is reasonable, brings down your total system cost, but you have to have that pairing perhaps. Okay. We're going to shift gears a little bit because it has also been a very interesting and tumultuous time in the oil market. I think just in the past month, Brent crude is down about 15%. Looks like we're at $63 and change right now. I believe I saw a headline on the terminal earlier saying it was the worst month in quite some time. So Salih, thank you for patiently waiting. Let's get you on, and I want to get your reaction to what's happening in the oil market. What do you make of the recent trend in pricing, and where could things go next?
Sure, thanks, Rob. And you are right. We are so this month is set to be the worst since late 2021. So it has been a pretty bad month for oil prices. And what we've been watching, and I think the two key drivers behind this has been, of course, the macro, which has become a lot more important of a driver for oil prices, and OPEC. So on the demand side, macro, I mean, we're seeing already that the trade wars are hitting GDP growth and hence oil demand. And just a couple of hours ago, we got the data on US economic growth, and that was quite weak. And then some of the Chinese factory activity data that we got earlier was also pretty weak. So I think we're already seeing some damage from trade wars. And this is all happening while OPEC Plus already told us, it has already started their output hike this month. They already told us that in May, they will bring back barrels 3 times the amount that was initially scheduled. And there's another meeting next Monday, and Bloomberg News had a survey of traders that they wrote on today, where majority of traders are apparently now expecting a May-like hike in output. So a big output hike for June to be announced at the meeting next week. So when you combine all of this, there's obviously a lot of anxiety and a lot of kind of downside risk that's been building for oil prices. So I mean, again, we think these, I mean, both of these are not going anywhere. We continue to see macro pressure building. And when you look at OPEC Plus, it's really not been clear, at least to me, what is behind OPEC Plus deciding to, accelerate their output hike. One argument has been that they're trying to punish some of the member nations that have been overproducing, and especially looking at Kazakhstan, perhaps Iraq. One argument has been this is an effort to strengthen ties with the US, perhaps, with the Trump administration. I mean, remember, Trump is coming to this region, to the Gulf, middle of May. So this could be a way for them to show cooperation. But I think, it really could be early stages of another price war. I think this remains a tail risk. I still don't think this is a likely outcome. But, if we see oil prices keep falling, I think OPEC Plus might find itself in a bit of a corner, with still keeping a lot of barrels off the market, but oil price falling anyway. So that would be an interesting development to watch. But again, something we're watching, of course, all the macro data, always important, but I think especially important given the current circumstances. And again, what OPEC does, always important, but very important to watch, especially the next one, which is on Monday.
Okay, thank you, Salih. And for anyone listening, if you haven't seen it, myself, Salih, Vince, Will, the entire team has been taking a look at what some of these bearish indicators could mean for some of the companies. I've got a note out this morning looking at Suncor and some of the Canadian E&Ps, and thinking about the idea of a kind of $50 a barrel case and what it could mean. And I think broadly for the Canadian E&Ps, it's pretty similar to where a lot of the U.S. and European majors are at. $50 is not good, but possibly you are able to sustain maintenance capex and dividend at that level, but buybacks are likely to be the casualty. I think that's the sort of basic narrative you could apply to most of the Western companies that are subject to the oil price. But Salih, you've also got a note that does the same type of exercise, looking at Aramco, but also some of your other coverage, Repsol and that kind of thing. So tell us, across the companies you look at, what does the $50 stress case for oil mean for some of your names?
Sure. So I actually had 2 separate notes. One was on the European coverage of mine, the mid-sized integrated, the Repsol, OMV, Galp, MOL, and a separate one on Aramco. And since there's a question in the chat on Aramco, perhaps I'll briefly mention what we are currently thinking on Aramco in a stress case scenario where oil prices move towards $50 a barrel. Generally, as you mentioned, we do think all of our coverage pretty much is pretty well positioned. They have balance sheets that are strong enough. They've come out of the 2022 upturn in a pretty strong position. So I think, our analysis focused on 2025 and 2026, and all across the board, they could weather that downturn. But as the question on the chat is alluding to, I think Saudi Aramco is in a unique position, because already last year they were paying this dividend that was way bigger than their cash flow generation, which meant they had to relever. And they went from a net cash position to a net debt position again. And when you look at 2025 and 2026, even if oil prices don't fall further, they will probably have a shortfall already. But our analysis showed that if oil prices go down to $50 a barrel, the shortfall they would have in their cash flow after dividends would be about $40 billion in 2025 and about $55 billion in 2026. So, I mean, that would obviously mean a significant increase in their leverage. We don't think, they had a special and performance-linked part of their dividend. That's already come down to, less than 1 billion barrels per day, but they have a base dividend of $84 billion. More than 90% of this go to the Saudi government and the PIF, the Sovereign Wealth Fund. So we don't think the base dividend is going to change. That's hugely important for the government. But obviously, if you keep the dividend, what's going to happen is their gearing ratio is gonna go up. But because they have had a net cash position and now they have a net debt position, but their gearing is in single digits, even in that stress case scenario, we only see their gearing ratio going up to about 15-16%, which is obviously much higher than where they were last year, where they are right now. But I think it's important to remember that generally global oil majors usually operate between 20-30% gearing, and in downturns they do push this much closer to 30%. So I think this obviously would put a lot more strain on their balance sheet, but they're in a position to weather it. And very briefly on the other note that we wrote on the European majors, as you mentioned, I think we estimate between 15-30% hit to their operating cash flow. Dividends are pretty safe. I worked on this note with our credit analyst that looks at these companies as well, and he told me that generally the rating agencies are pretty comfortable in terms of their dividend coverage as long as oil prices are above $50 a barrel. But I want to say what we argued was that buybacks would be the first lever, the most flexible lever to be adjusted. But interestingly, both Repsol and OMV reported today, and essentially what they showed is that they have some room to maneuver capex, and I thought that was interesting. And what Repsol said was that they actually coincidentally called it a stress case scenario as well, similar to our note. And they said in that scenario, they can easily move their capex down by about $500 million, which kind of showed me that shareholder returns remain very, very important, including buybacks, not just dividends. Buybacks remain very important for these companies. And also, I thought interestingly, OMV said that they can adjust some of their transformational investments. So it looks like before they touch, OMV doesn't have buybacks, but before they touch their dividends, it looks like they may adjust their capex as well. And it looks like they might adjust the energy transition related spending perhaps before any of their other core businesses. So I thought that was interesting, so worth mentioning.
Yeah, thanks for that color, Salih. Let's close out the call with doing a quick round robin of coverage and break out some of the details from the earnings space. And I'm going to go first. Just notable company in my space, First Solar reported last night. Stocks off about 9-10% here this morning, and I think it's interesting because I actually think that a lot of the discussion actually isn't all that different from some of what you're hearing on the oil companies these days. I mean, it's tariff, trade headwinds, right? And I think there was some initial reaction on First Solar where this idea that tariffs are good for them because they are the major U.S. module manufacturer with a lot of domestic output, and that tariffs could be good. But as they noted on the call and discussed, they are not exclusively vertically integrated in the U.S., and they do have exposure to global supply chains. They do have manufacturing outside the U.S., and that portion of their footprint is going to be perhaps a margin headwind going forward. So I think the sort of basic readout from the names I look after is that 1Q, nothing awful or great per se, nothing to write home about, and a lot of focus on what the remainder of 2025 looks like. And in that, and along that line, we're hearing lots of caution about trade, tariff headwinds, and just general macroeconomic uncertainty. So let's flip over to you next, Patricio. For your coverage that's reported out so far, what are you hearing?
Yeah, so that's interesting. Iberdrola reported results today. They had a relatively strong first quarter of earnings with growth year over year, despite them having really extraordinary gains last year. So the short story here is that utilities in Europe that are investing heavily into grid infrastructure have a more sort of benign earnings outlook for the next 2 years. While on the flip side, these are usually integrated companies that invest both in grids and renewables. When you look at the renewable space, I think headwinds remain. Like you just mentioned, is not only tariffs and the paring back of investments in the U.S., but it's also lower power price realizations in Europe and a more competitive landscape for development in general. So I would say overall a mixed bag, but utilities continue to be sort of a relatively defensive sector with an even higher share of regulated earnings at the moment. So let's say mid-single digit EPS growth over the next couple of years, but it's still a low growth sector, but with resilient qualities.
Fantastic. Joao, let's come over to you. Are your European utilities a safe haven here at the moment?
Well, I would just add for renewable developers that actually, funny enough, 2025 might be, from a profit point of view, might be a strong year due to the record additions of projects last year and the output gains this year. But as Patricio said, that's set to normalize with slower investment going forward and the exposure to lower power prices. And then utilities broadly have a flat earnings outlook for 2025, the sector on average, which perhaps looking at the risks that other sectors are now facing from tariffs can be seen as a safe haven. And there's very little profit exposure to tariffs, even for the periods that are exposed to the US. That exposure is more on capex rather than profit. So in that sense, the answer is yet partly they can be seen as a safe, more defensive sector.
Great, Salih, over to you.
Sure. So, I mean, as I mentioned, I had OMV and Repsol this morning. It was a miss for OMV. It was a beat for Repsol, but it didn't really matter in the end, which kind of shows me that it's anxiety around, the global trade risks and, the benchmark oil price pressure is what the investors are focused on. Both companies, the share prices for both companies were down. I think Repsol recovered a little bit in the end, but I think beyond just this quarter's earnings, I think everybody's focused on what comes next. But perhaps important to note, when we looked a little bit more closely on OMV, since its acquisition of Borealis, chemicals is a much more important segment for them, and there is clearly still a lot of pressure on prices and on margins in the chemical space. On some of the products, we've seen there was some signs of recovery, but clearly there are sector-wide headwinds for them still on a lot of the products that they sell. But I think generally the fact that investors are probably still focused on macro so much is for these type of integrated companies, like these global trade pressures really impact all key segments. It's not just upstream because oil prices go down. It's also fuels demand. It's also refining margins. It's also chemicals demand. So we can look at these quarters and how there was a slight miss or slight beat, but usually the market focuses a lot more on the outlook and on the future. So and there are a lot of concerns still for all core segment of all these companies. And I think that's why we saw a lot of pressure on stock prices today, irrespective of how they reported on Q.
All right, I think we'll leave it there. So for everyone, if you look up any of our bios, you can go and read our notes on the blackout in Spain, on the stress test case for $50 oil, our reactions to some of these tier one companies as they report out their earnings. So make sure to check out our written content on the terminal, and we're happy to follow up with you if you have questions. And if we didn't get to anything that was on your mind here today, just shoot myself, shoot anyone on the call in IB. We're happy to continue the conversation. And just as a reminder, we hold these calls every Wednesday at 10 a.m. New York time, 3 p.m. London, and we look forward to having you on the next one or one of our future ones. So take care, everyone. Hope you have a great rest of your week. Cheers.